Is Jason invited? Let's, if we can start returning to our seats, we would like to keep the process moving so we can honor the agenda. Now, as you're coming back in and you look toward the stage, you probably notice a couple things that don't make sense to you. Neither Jason nor I look like the new athletic director of the University of Pittsburgh. There was a little bit of a scheduling conflict, so we're just flip-flopping time spots with Heather Like, so she'll be on when Jason and I finish our presentation in about 50 minutes. So we look forward to that. And as we were changing the time and he was walking out, Bob said, well, you have to mention that because you're not as interesting as Heather Like is going to be. I said, but at least we're more interesting than the last pair. So we're all pretty good with that. And Bob was appropriate in thanking everybody who puts this together, but let's also thank the folks at South Point Hotel and Conference Center that allow us to have this many people in this room and do a great job with that. So shout out to them for sure. A couple thoughts before we dive into the ANA update is that if you just think of a few things, think of 728 days. 728 days ago, November 10th, 2016, was our last ANA update. So I know that many of you have been waiting 728 days for this moment. And it's going to be a little different than the tax presentation that you saw this morning for a number of reasons. First of all, we really don't get to talk about politics nearly as much. Well, GAAP has a challenge. I mean, accounting principles are really challenged with regard to piquing people's interest. We are insulated from politics. So we have no real impact of midterm elections, but there was a very important scientific discovery that came from our last election cycle. It seems as if those scientists who asserted that the cheetah was the fastest land mammal on Earth had failed to time a politician sprinting for a camera. So we now have that important discovery as we move into ANA update. Looks like everybody's back, so we'll talk a little bit about our objectives for today. We are going to talk about recent changes to US GAAP and those that are applicable now or applicable soon. If we have time, which we probably won't, we'll touch on some of the things that they're working on for the future. We want to summarize it, not go too deep into really any of them. We'll talk a lot more at a different presentation this afternoon about revenue recognition as that becomes applicable here in several weeks. We'll talk a little bit this morning in this presentation about leases because that's becoming closer and closer on the horizon. But we want to create an expectation. That expectation is a fundamental premise. We are focusing on a private company perspective. The fundamental premise of public company reporting is that the users of financial statements do not have access to the reporting entity. So accordingly, if I'm an analyst at a big brokerage firm, I really crave a lot of granular detail. I really crave a lot of fair value stuff. I really might even like level 1, level 2, level 3 delineation of the fair value hierarchy. But on the other hand, a private company reporting entity is very different. The fundamental premise of private company financial reporting is that the user of the financial statements has access, if desired, to the reporting entity. So accordingly, the focus shifts a little bit more inclined to historical cost, a little bit more to breadth of disclosure and simplicity of disclosure to inspire those contacts with the reporting entity rather than needing to figure out all the analysis from what is presented. And this allows for the theme that you're going to hear from Jason primarily and a little bit in some of the slides that I have about the move of the FASB the last handful of years to make things a little simpler, which was a long time in coming and much welcome. We'll also avoid certain things. We'll avoid IFRS. We'll avoid the SEC and PCAOB matters for what I just mentioned. We'll avoid most specialized industries, healthcare, banking, gaming, government, etc. We try to avoid derivatives and hedging, but we're not really able to completely avoid it. So we'll have a couple of slides in that regard, particularly insofar as they relate to private companies. But since this is a GAAP update and not a GAS update, we will not really delve into audit standards. Audit standards change, maybe not as quickly as accounting standards do, but that's not really the topic for today's presentation. So Jason's going to spend a little bit of time talking about changes to US GAAP that are applicable now or soon.
Thank you, Jeff. Jumping right in, the first of the newly applicable ASUs that we have to present on is 2014-15, and this is a going concern. Sorry about that. This is a going concern topic, and traditionally, we've always expected management. It's management's responsibility to evaluate going concern uncertainties, and in the past, management was able to potentially delay the release of financial statements to get beyond that 1-year deadline that was required in terms of assessing going concern uncertainties. This ASU changes that timeline, essentially. So whereas before you could wait a year to issue your financial statements, and at that point you know you've passed that 1-year deadline in terms of going concern, now the evaluations and disclosures are to go 1 year beyond the issuance date. So you aren't able to kind of take that shortcut of waiting a year and issuing those financial statements. You have to go 1 year beyond the actual balance sheet date, or I'm sorry, issuance date. Another ASU that we have is 2016-09, and this is with regard to stock compensation and share-based payments. Now this is for both employees and non-employees, so if you're paying vendors or other parties on a share-based transactions, this is applicable in both situations. So as Jeff mentioned, a lot of these standards updates have a simplification or clarification aspect to it, and this is one of those. So this is aimed at simplifying prior guidance, and there are 3 main areas of simplification that you'll see here in this ASU, and those are with regard to the classification of the awards, the tax consequences, and the treatment in the statement of cash flows. So from a classification standpoint, in the past, when you had a tax benefit or a tax deficiency that was greater than or less than the actual compensation expense, the benefits would go straight to equity, and any deficiencies that you had would go against equity to the extent that you had accumulated benefits there. Once you exhausted those benefits, that difference between the tax treatment and the book treatment or the actual compensation expense would go to the P&L. Now it's been simplified and streamlined. All the differences between the tax treatment and the book treatment will go straight to the P&L going forward. Now this will result in some tax volatility for some companies that use a lot of share-based transactions and compensation. So that's something to keep an eye on as you look at your tax figures if you do a lot of stock-based transactions. And from a statement of cash flows perspective, in the past there was diversity within diversity in practice on where people would place those in the statement of cash flows. That should all go to operating activities now. And there are some provisions for non-public entities. So there's a practical expedient for determining the expected term of certain awards. Non-public companies are able to take a bit of a shortcut there. And additionally, private companies are able to take there's a one-time opportunity to change the measurement basis for those agreements at the time you adopted the ASU. And lastly, there's a second ASU 2017-09 that also has an impact on stock-based compensation. And this is another clarifying standard, and it clarifies when changes in the terms of a payment award should be treated as a modification. So when a modification occurs, you have to go back and reassess the accounting that was originally, or the transactions that were originally recorded for those agreements. And what was happening is too many businesses or their third-party providers were going back, and when there were minor changes to a stock-based compensation agreement, they were going through the entire process of reassessing that contract again. So this ASU essentially makes that process more simple and says, if the fair value, vesting, and classification don't change, there's no modification required in terms of going back and reassessing that stock-based compensation. Moving on to our next ASU, 2016-15. This is another situation where they're trying to bring some consistency in practice to how certain transactions and cash flows were being classified in the statement of cash flows. So the most The most notable items within this ASU are that debt prepayments should always go through financing activities on the statement of cash flows. There was some diversity in practice there on how those were handled. Contingent consideration in a business combination, that should be classified as financing activities in the statement of cash flows up to the original amount of the contingent liability that was recorded at the time of the transaction. If that figure, if the amount actually paid in contingent liabilities changes throughout over time, any additional amounts paid over that original liability would go to operating cash flows. And any insurance proceeds that are received should match the coverage treatment that was recorded for the policy premiums. And any corporate-owned life insurance policies, any activity there should always go to investing cash flows. The next ASU is 2016-14. So if you work for a nonprofit or if you are involved on the boards or committees for any nonprofits, you may already be aware of this, but this is not an overhaul to nonprofit accounting, but certainly some significant changes are going to be happening with the way that financial statements are prepared for nonprofit entities. So the biggest thing, or the most notable change that you'll see, we're moving from a 3-class net asset treatment to 2 classes. So previously there were unrestricted, temporarily restricted, and permanently restricted net assets. Now we will be moving to a system where we have with donor restrictions and without donor restrictions. So the with donor restrictions is going to be a combination of that previous temporarily and permanently restricted net assets. And you'll still be able to show that detail in the disclosures to the financial statements, but they won't show up on the face of the statements anymore. So it should make the readability and understandability of those financial statements a little bit easier for people who aren't as well versed in nonprofit financial reporting. Another major change is the statement of functional expenses will now be required for all nonprofit organizations. Previously, that was just for voluntary health and welfare organizations. And that'll also come with additional disclosures with regard to how the organization is recognizing and allocating those expenses across operations, G&A, and fundraising. Another change that you'll see is within the footnotes of the financial statements, and that's a new liquidity footnote that's being added. It'll provide some commentary on the financial health of the organization and its liquidity, the liquidity risks, and any donor-imposed limitations on cash that's on hand. And it'll give management an opportunity to add some color to the financial statements with regard to some quantitative and qualitative commentary with how cash is managed within the organization and where the cash resources are going to be coming from in the next year or in the near term. And lastly, there's some changes to underwater endowments. They can now be shown as negative instead of being reflected as a reduction in net assets without donor restrictions, which is typically what was done in the past. And the last change that we're noting here for nonprofit accounting on ASU 2016-14 is the treatment for long-lived assets that are donated to an organization or when restricted funds are used to purchase long-lived assets. In the past, there were 2 options. The release from restriction could be recognized immediately when that asset is placed into service, or it could be recognized in line with depreciation as those long-lived assets are depreciated. Because of this ASU, the second option is being eliminated, and you'll only have the ability to release from restrictions upon that asset going into service. ASU 2016-16 relates to income taxes and specifically on intra-entity transfers of assets other than inventory. And this improves the accounting for transfers between related companies and is part of a simplification initiative. So again, that theme of some of these items being simplified or clarified. And the aim is to reduce the costs and complexity but still maintain the usefulness of the information that's in the financial statements. Prior code didn't allow entities to recognize the tax effect when the assets were transferred from one organization to another and required a sale to an outside party before those tax implications could be recognized. Now, under the new code or the new guidance, the current and deferred tax effect is recognized upon transfer of those assets from one entity to another. We have another ASU that relates to the statement of cash flows. This is 2016-18. And this really just relates to the presentation of restricted cash versus unrestricted cash. Essentially, there was a lack of consistency in treatment by preparers of financial statements. Some were putting the restricted and unrestricted cash in different places in the statement of cash flows within operating, financing, and investing. And this ASU addresses that diversity in application. So based on the guidance in this ASU, there's a requirement that all cash, both unrestricted and restricted, is reflected in the statement of cash flows, and any transfers between restricted and unrestricted would essentially net out. And when cash and restricted cash are presented in separate lines on the balance sheet, there's a requirement to just show the reconciliation to ending cash on the statement of cash flows. ASU 2017-01 relates to business combinations, and again, this is an attempt to simplify and streamline how these transactions are handled. In the past, the definition of business versus asset was relatively vague in prior guidance, so there were situations where organizations were purchasing assets of another organization and classifying it as a business purchase instead of a simple asset purchase. And that became time-consuming and costly. And so this ASU was prepared to address that and should reduce the number of events that are subject to business combination treatment and disclosure. So what happens with this ASU is that the definition of a business is clarified, and an entity first make an evaluation if substantially all the fair value of the assets they're acquiring is concentrated in a singular asset or a group of similar assets. If that's the case, this is not a business transaction, it's just a purchase of assets. And, but there's still a little bit of vagueness there because substantially all is not a defined figure. So there's still some judgment that needs to come into play when making this determination. Typically, about 90% is what some of the commentary on this guidance has indicated. But you also want to look at the intent of the buyer and the seller. If a company is buying 20 trucks from a company that dealt with trucking logistics, are you buying that company or are you simply buying their old trucks? So it's something to look at when you're determining how those transactions should be dealt with. ASU 2017-04 deals with goodwill. And again, simplifying prior guidance, it eliminates the requirement to calculate the implied fair value of goodwill in the goodwill test. So that's essentially the old step 2 of the goodwill test. And instead, entities will be able to record an impairment charge based on the excess of the carrying amount over the fair value. Now, we've addressed the upcoming changes. The recent changes to GAAP Jeff will take care of.
Good. I think what we're going to do now is lighten it up a little with a little derivatives and hedging. And thankfully, the next 6 or 7 slides all come under the umbrella of that simplification that Jason mentioned, or we both mentioned, and also common sense theme. It's always helpful when there's a little bit of common sense behind a standard setter in any regard. So what are they doing with derivatives and hedging? Because normally, simplification and derivatives and hedging in the same sentence create some sort of oxymoron sentence. But in this case, we think it's actually going to be very cool, albeit for a very small percentage of the population. But what they're doing, and you could early adopt it if it's helpful, what they're doing is they're actually broadening the disclosure of what risks you would be hedging. So now going forward, you're not required to only hedge financial risks. You can also talk about hedging non-financial risks with your derivatives and hedging. They're eliminating the benchmark interest rate. Now, most people probably didn't even know there was such a thing. But whenever you are comparing a hedge, think of the simplest hedges that are out there, a variable rate loan to a fixed rate for a term note. You actually had to use as your benchmark something that was in a list that the standard setters had decided. LIBOR, prime, Fed funds rate, something like that. That's relevant for a big body of the population, but not for everybody. A nonprofit doing bond issues for large construction projects, maybe the relevant benchmark for them is going to be the municipal tax-free bond rate or the tax-free bond rate. So you now have a lot more freedom. Now, of course, you have to tell people what you did, hopefully why you did it, but it is going to be helpful for many. Amongst the helpfulness for the readers, that's helpful for the issuers. Helpful for the readers will be that you now will disclose the effects of your hedging on the same income statement line that you disclose, or section that you disclose the effects of the item being hedged. So we're now no longer kind of separating the cause and the hedged item by many pages or several footnotes or several lines or several sections on a statement. Those are going to be grouped together, hopefully of some help to the readers of the financial statements. So there's one other thing that was eased a little bit before, and this was that test of highly effective. If you want to, if you're an accounting senior, if you're a senior accountant in an audit team, and you really don't want to deal with your staff for the next 3 or 4 days, tell them to go test the effectiveness of a given hedge. They'll be in the quagmire, you won't see them for several days, and they'll come back with something difficult to understand. So I think what they've realized that is not helpful for these things like these interest rate hedges. So they've now said, let's get rid of the highly effective test. Now you'd relieve from that already with the interest rate thing, but it's now further relieved. You don't have to have that tight coincidence of terms and notional amounts not above the note amount, the term not in excess of, and a number of things like that have been further relieved. So very helpful, but again, just for a small percentage of the population. So beyond derivatives and hedging, what are the things that apply to a much higher percentage of companies that cause a lot of confusion? Other comprehensive income and deferred taxes. I'm guessing we don't have a lot of rebuttals to that. So now let's talk about simplifying both of them in one step. Because whenever someone is reading an income statement of a private company, a taxpayer though, a C Corp, and they're trying to reconcile the deferred taxes, to the tax rate, to the tax footnote, what throws people off an awful lot of the time? The amount of deferred taxes that relate to the other comprehensive income. It's important to do. Unrealized appreciation on securities and so on and so forth. But then we had a funny thing happen last December that Dawn and Bob spent a long time talking about this morning, and that's this Tax Act, the Tax Cuts and Jobs Act, or whatever they were referring to it as. And that changed the deferred taxes for everybody that had net deferred tax assets or liabilities. If you were in that liability position, you related. Your rate change from 34 to 21 just boosted your equity some way or another, or your OCI. If you were in a net asset position, it shrank a little bit. But now what we're saying is that if you have impact in OCI, it was really hard to see it. So we're saying just for the effects of this Tax Act, we can take the deferred tax impact of the tax rate change out of OCI and stick it with the rest of the taxes. So that's very, very helpful. Now, if you look at the date, it's pretty funny. They didn't issue this till February. So by years beginning after 12, 15, 18, nobody's really going to care anymore. So I think if it's helpful to you, you want to early adopt, because it would be for calendar 18 and to some extent comparative to 17. Stock compensation. Well, stock compensation is always an evolving area. There have always been ways to compensate employees and others with things other than cash. Amongst those things other than cash would be equity of some sort. And there's a lot of rules and a lot of guidance with regard to how to measure it, how to recognize it, and so on, with regard to incentive stock options, with regard to phantom stock, appreciation rights, and the whole 9 yards. But there are a lot of folks other than employees who benefit from these awards. We're accountants, as most of us in here are accountants, we're not really permitted to, but our friends that pass the bar are permitted to receive share-based compensation, as are sometimes architects, as are sometimes other service providers. So what to do with that? Well, the common sense would say that it would be very similar to the share-based compensation for employees. But since it wasn't codified, people took the opportunity to take non-common sense approaches. Now what this is saying that you use the same method. The same method that you use to give your lawyer or your director or your architect shares or an appreciation right or an option, it will mirror what you do for employees. You'll disclose how you're valuing it, the option pricing model. If it's Black-Scholes, it's Black-Scholes. If you said I contracted SVB Analytics, so then you contracted SVB Analytics. Whatever it is, you disclose it just like you would for the employees. You also disclose essentially the conformity of the cost attribution with the enjoyment of the award. That's kind of the vesting thing. Just like in an option, you recognize the expense, legal expense. You'd actually capitalize the architectural fees in most cases. But you'd recognize the outcome as you cleared the hurdles from getting there, as you cleared any barriers to enjoyment. So that's really also going to mirror the employment side. Now, it only applies to areas where you're purchasing goods or services from outside parties. It does not apply when it's in connection with selling goods or services to a customer. That comes under the revenue recognition guidance. So if it's a situation where if somebody buys enough from you, they get an appreciation right or an option or something like that, then this guidance does not apply. There's separate guidance in the codification section 606. But this still will cover a lot of things. Some more common sense with the nonprofit entities. I have had the pleasure of sitting in a lot of esoteric debates, or at least a few of them, where they were talking about how to differentiate between a contribution and an exchange transaction. Well, contribution really follows the general English usage. An exchange transaction is something where there is commensurate value exchange between two parties. It doesn't have to be exact, it doesn't have to be the same character, it just has to be commensurate. So then a lot of funny questions happen. It's pretty simple. If Mark just writes a check to the Animal Rescue League, it's a contribution. But now what happens whenever somebody's making a grant from the Jason Hardy Foundation to the Animal Rescue League? Well, gee, he's doing that for a purpose, right? Is that an exchange? Well, if it's merely to have the entity continue with its mission, staying on mission is not an exchange transaction as now defined by the new ASU. That's very, very helpful in many, many regards. It almost didn't matter which side they landed on, just so long as we had some sense and some clarity. Similarly, what to do with all these government grants? Because there's a lot of government funding to a lot of organizations that say, I will give Jason $100 a day to feed Lori 3 meals a day. And if it's something that direct like that, it's smelling a lot like an exchange transaction. But if that same government grant says, I will give Jason $10,000 to further his program, to evaluate new programs, to build a mission or to better society, because feeding Lori, in theory, betters society. If it's merely to better society, that has been defined as being outside the definition of an exchange transaction. So again, thankful simplification, thankful clarity. Thankfully, that will allow one of the two of us up here to avoid being embroiled in quite as many esoteric conversations about whether that government grant is an exchange or contribution. Because interestingly, we're going to land in almost the same place. They also help with some other things. So if there's a contribution, and again, a contribution, which of course is non-reciprocal, can be conditional. Jason, I'll give you the $100 a day to feed Lori if and only if you wash my car, or whatever the conditions are. Usually they're obviously much more mature than that. So when does one recognize the contribution? Well, in that case, Jason would recognize the $100 upon completion of the washing of the car. Now, a lot of conditions are kind of general, sort of like there are several bank covenants in a term loan that are very meticulous and very important. Others are kind of simple, staying in business and not breaking any major laws or committing treason. So a lot of contributions have conditions like that you will not violate any laws. That's one of the most common ones. In the FASB said, you know, if the risk of the condition becoming operative is remote, it should be treated as unconditional. So that helps that quite a lot as well. Moving to some fair value measurements. Well, I think because I can't help with a little editorializing from time to time, I've already betrayed my view of how helpful the delineation between level 1, level 2, and level 3 assets are for private companies. Some degree of it would be extremely helpful. But splitting hairs and calling a money market account a level 2 investment as if it's difficult to discern the value that I could get back from Citizens Bank or PNC or somebody else is some sort of mystery, I'm not sure that helps most private company users. So we're not really abandoning the levels yet, but we're giving a little bit, throwing a little bit of a couple of crumbs to the private company users in particular, and we're really reducing several disclosures, and we're modifying other disclosures. So for example, we no longer have to put in the table for level 3 assets. It shows where were they at the beginning, what went in, what changed, what did we buy, what did we sell, what's our ending point. We certainly still have to show the transfers in and out, certainly have to show the process for valuing them, but we're eliminating some of that disclosure that many, many users were not finding particularly helpful. Furthermore, there's also a number of things that are really valued based on net asset value, either of the item or the underlying holdings. And a lot of times those are fully redeemable. And I think there's been growing realization that even if it's not publicly traded, even if it's not traded on an active market, even if it's another instrument, and I can redeem it with a phone call or logging in, and I could redeem it at any point during the day or every 24 hours or something like that, then it's not really as illiquid as a long-term investment in a piece of real estate might be. So there's a lot of easing on that and the disclosures that relate to those, and it's moving more to saying, what's really important in that environment? What are the redemption, what are the holders' options to redeem that asset? And when will those lapse? Is there an expiration that Jim has to exercise this by 12/31/18 or his opportunity to get rid of it goes away? So the levels become a little more simplified in their disclosure. There's some additional disclosure related to uncertainty. So there's always been an uncertainty disclosure in this area about saying, gee, we are counting the pennies and estimating the millions. So for goodness sake, if I'm estimating the value of a level 3 investment, it's going to change. Even if I'm taking the amount today that U.S. Steel is trading, which is a level 1 asset, it doesn't mean that 6 months from now I will be able to redeem it for that amount. So there was a paragraph that was formulated by the FASB to tell the user the obvious, that, hey, these things change. They've now embellished and enhanced that paragraph to emphasize the uncertainty to the users. And there are some additional disclosures that are required, but private companies escape those, so we won't talk about them. Another area that is of very much difficulty to most users of private financial statements are the disclosures related to defined benefit plans. Now, we're not talking about when the plan is the issuer. This doesn't touch that. This relates to sponsors of defined benefit plans. And if anybody's ever looked at a set of financial statements of a sponsor of a defined benefit plan, if those financial statements are 30 pages long, 7 or 8 of those pages are probably the DB plan disclosure. And in 2007, the then chair of the FASB spoke in Pittsburgh. I had the pleasure of being at his presentation. It was to a relatively small group, and he was adamant, he was passionate, saying of his agenda, one of the most important things he thought he could do as the chairman of the FASB was to completely revamp the DB disclosures for private companies. And he even used a euphemism for what he thought of it, saying that the disclosure requirements were a bunch of hooey. Those are his words. Then 2008 hit, and he had other priorities, so it still hasn't happened. So we've had to gain ground like inch by inch in this regard. So what happens here is that we have a little bit of help. The level 1, level 2, level 3 are improved a little bit. It's going to mirror a lot of what we just mentioned, but it should shorten it up a little bit. Of those 7 or 8 pages, we might chop half a page off, but be glad any ground we gain is ground we gain. Also, remember other comprehensive income, very confusing. DB disclosure, very confusing. The actuaries actually help us break out the effects of all these different things, and some of them land in the income statement, some of them land in the benefit obligation, and some of them land in other comprehensive income. And you actually disclosed certain things that were going to pop out of there and land in net periodic pension cost in the subsequent 12 months. And I think that they discovered that very few people were looking at that or being helped by it, so now that's gone. But there still has to be, appropriately so, thorough explanation of any significant gains or losses that impact the benefit obligation. And think about what would be the most likely impact on the benefit obligation. It would be a lengthening of mortality tables. Internal use software. Well, internal use software has a lot of, basically, the long and short is you capitalize the development of internal use software between the point of technological feasibility and essentially usability or inventoryability. But a lot of confusion was happening with regard to cloud-based products, the Salesforce.coms, Financialforce, NetSuite, Intact, and all of those. There was a pretty good science now since the mid-'80s or late '80s and then into the '90s on what to do with implementing SAP and things like that. You capitalize the implementation cost and assistance, you expense the data migration, you expense the training and support. Pretty set in stone. But what do we do if it's Salesforce.com? It's only a subscription. And remember, everything, all the literature, most of the literature regarding subscriptions says you expense as you go. And most of the literature says that when you're looking to capitalize or not capitalize something, your decision should follow the related asset. So that became a point of confusion. So I said, well, gee, if you're actually just implementing Salesforce, even though it's a subscription, we won't change the way you account for your subscription, but we will now follow the rules for other similar implementations because the character is much more similar to the company. The company, the users in the company and the company's investment oftentimes can't tell the difference whether you're licensing the software or paying a monthly subscription or an annual subscription for it. So it's now said, let's conform this to the on-prem type of things. We're going to capitalize the implementation costs. We're going to expense the training, data migration, and support. I mentioned before that we'll cover revenue recognition in a separate presentation with Mark and Eric this afternoon. But Jason and I are going to talk a little bit about leases because the new lease pronouncement comes quickly on the heels, a year from January, for private companies. So it's important to become more and more comfortable with it because for many it will be underwhelming. But for some, the adoption will be a tedious process. So how did this happen? So we've been with FAS 13 since 1976. And a pretty long time ago, like the early 2000s, the international standard setters and the FASB said, let's get out of this off-balance sheet financing world. Because even though at the bottom of every statement, your balance sheet, your income statement, it says, please read the notes to these financial statements, they're really important, or some paraphrase of that. A lot of people don't. It's sort of like when we do a proposal, if you can measure the eyeballs, they seem to land on the fee page. So they found that with financial statements, the eyeballs go to the income statement page, and not enough eyeballs were going to the operating lease commitments. So off-balance sheet financing was a big deal. And after 10 years of wrangling, the US and the IASB deviated a little bit from one another, but each actually landed somewhere. And now we'll just have basically, we'll talk a little about lessee and lessor, but we're really going to have two primary types of leases. Operating, which will seem an awful lot like they did before, other than this right of use asset. And since we had to show something for 10 years worth of work, they'll no longer be called capital leases, they'll be called financing leases. But when you look at how they're presented and how they're amortized, they will be very reminiscent of capital leases. Mark Twain is one of my favorite authors. I think he's brilliant and funny. And as Mark Twain says, history doesn't repeat itself, but it sure does rhyme. So other than moving the obligation and the asset to the balance sheet, this will rhyme quite nicely with many aspects of FAS 13. So before we hand it to Jason to talk about the impact on lessees, we're just going to talk about the overall impact. This impacts everybody that has any leasing contract of any sort, with certain exceptions that we'll lay out at the end. If it's a contract that you viewed as a lease before, it's probably subject to this. It includes subleases. It includes certain initial direct costs and some other things like that. And it really uses almost the same criteria as we have in the past. Remember the 4 criteria for capital lease? Transfer of ownership or bargain purchase option. They're kind of still there. They change the word a little bit and they kind of mash them together. But if ownership transfers, it's a financing lease. Pardon me for calling it a capital lease. We also had this really nice thing, the 75% of useful life or the present value exceeding 90% of the fair value at inception. Those are very nice. They're very convenient. We know the leasing companies reverse engineered that to being 89.999% oftentimes, but they were still very convenient. So now we have this substantially all stuff. If substantially all of the value is encompassed in the lease payments, it's a financing lease. And Jason already talked about the murkiness of substantially all. So I think as a proxy for substantially all, a lot of people are actually going to use the 75 and 90% tests informally as a measure of substantially all. Because substantially all will never be appropriately codified. And when he was saying, I was thinking, you would never see that in the Hallmark card. You have substantially all of my love. It just isn't going to play particularly well. So I think what we're going to have to do is, in spite of that principles-based acquiescence to the international standard setters, we need to bring a little more kind of codification to it. So I think a lot of folks are going to use the handy old tools that we had before. Now, we have one more thing that's a kind of a common sense thing. It is a financing lease if the lessor has no alternative use at the end of the lease period. You say, well, why would that ever be? I lease the car, it's done, it still works, right? Well, the one we're going to pick on in our examples are the phone systems. Those of us that have been around before everything went to one of these, remember that we used to spend almost extortive levels of money with whomever to put this big set of wires in a closet, and then they would lease it to us. And it was going to be there forever. The lease term might have been 3 years, but it was until we tore that room down and did a build out. And the phone company knew that. They knew there was no alternative use for that. They never came and took one of those. So that would now, in spite of the engineering of the terms of the lease, either one way or another, by virtue of thinking of all likely renewals or by virtue of no alternative use, it's going to trigger it to being a financing lease. Now, Jason's going to talk about some of the details on the impact on lessees of the new lease pronouncements. I'll come back in a few moments to talk about the impact on lessors, and then we'll wrap up from there.
All right, thank you, Jeff. So Jeff already touched on most of the high-level changes with keeping the name of an operating lease, but changing it to back on balance sheet. And then essentially for capital leases, there's a little bit of terminology change, but mostly you're just changing the name of it from capital lease to finance lease. So as Jeff mentioned, lessees will be most significantly impacted as lessor accounting is not going to change very dramatically. And the operating lease will be pulled onto the balance sheet through that right to use asset and an offsetting lease liability. However, lessees may elect to leave leases that are shorter than 12 months off the balance sheet and treat those the same way that the old operating leases were handled previously. Now, that liability that'll be put on the books is calculated based on the present value of the lease payments. Now, in calculating that, the interest rate that you're using in the present value calc is similar to the old models or the old rules that we used to use. You can use the discount rate if readily available, or you would use the incremental borrowing rate for that organization. And the asset that goes on the books is going to be equal and offsetting based on that present value calculation. However, the asset that goes on the books may exceed the liability if there are additional direct costs. For example, if there's site prep or something like that, a new machine is being put in and you have to shore up the foundation of the facility floor in that area and reinforce it to bring that asset in that's being leased. That would be something that you could capitalize above and beyond the present value of those lease payments. There's a dual model approach for the two leases in terms of the income statement. Although both will be on the balance sheet, the expense recognition pattern will differ. For operating, you'll recognize the expense on a straight line basis over the lease term, again, based on the present value of those lease payments. For financing, on the other hand, you'll recognize both interest expense and the amortization expense. Again, similar to what had the treatment previously with the old capital lease. Therefore, a lessee would generally recognize a greater expense if it's an operating lease. You'd recognize a greater expense earlier in the life of the lease. I'm sorry, I switched those around. You'd recognize a greater expense earlier in the life of the lease for a financing lease versus an operating lease. Jeff will now talk about the impacts on lessors.
Well, lessors have a lot more fun. They had a better lobby. One of the things that held up this through many exposure drafts, and I've admitted before, maybe on this very stage, that I made the mistake of reading all those silly exposure drafts, and now I can't remember what was in which what's in the real one. But the real one is actually a lot better than most of the exposure drafts, especially for lessors. Lessors' model remains, again, substantially the same. Lessors lose one thing. They lose leveraged leases. Almost nobody had leveraged leases. Lessors, if you have operating stays the same, remember? And you also have capital leases, now financing leases. Financing leases for lessor were divided into three categories. Sales type leases, direct financing leases, and leveraged leases. Leveraged leases were kind of the unicorn of the mix. A leveraged lease only happened when your lease payments were not sufficient to cover the interest component of the transaction, so your actual principal obligation continued to grow through the lease term. That's a very rare animal, so they just did away with it. So now what they did, though, is they really kind of conformed the other ones with the new revenue recognition guidance. When they were working on it, didn't know which one was going to be effective before the other, so they took a little extra care to leak a little more of that Section 606 stuff into the lease pronouncement. But anything that you see changing for the lessor's perspective is probably to bring it into conformity with the new revenue recognition guidance. And you see things that really go as follows. Direct financing leases are still treated just like, they for all intents and purposes, like they were before. Some changes with capitalization of certain costs, some changes from some other pronouncements with regard to contract acquisition costs, some changes to some other little things, but a direct financing lease is still a direct financing lease. You're basically recognizing the interest income, over the term of the lease. Sales type leases were designed to say, gee, and there must have been an abuse before my time, there must have been an abuse. The sales type lease was we wanted to prevent the lessor from recognizing all of the margin, the producer's margin or the distributor's margin at the inception of the lease, which I'm sure they would have wanted to do for financial covenants and not for tax purposes. But sales type leases basically say, no, you can't do that. We have to normalize it over the term. You got to recognize this in a way that is commensurate with what the transaction is occurring. And the sales type leases primary impact does relate to the revenue recognition. And that can be a little bit more meaningful. Also, sales leaseback guidance. Sales leasebacks also, we're saying, what's the real essence of that? I'm selling it to Jason and I'm leasing it back to Jason. And there's accounting for not basically recognizing a big gain on that transaction. Hey, Jason, I need to gross up my balance sheet. How about I sell this podium to you for $1 million and I lease it back to you, and or something silly like that. And there was guidance for a long time that tempered that kept that from happening. But some of that guidance was actually in conflict with the new revenue recognition guidance, so that has been brought into conformity. Those are really the primary changes for lessors. But there are several important matters. How do we deal with this? What does this cover? It's the initial term plus all likely renewals. Remember the phone system I was picking on. You're never taking it out. Doesn't matter if the term's three years. If it's going to be in there for the 10 years till you leave that space, then you're likely to have renewals. You factor those into your measurement from the beginning. Now, this is interesting because this differs from FAS 13, or whatever codification section that morphed to. If there were changes to the term, contingencies, or other contract changes, you have to remeasure the lease, rethink it, redo it. Now, they have to be meaningful enough changes. There was some helpful guidance that came that said, if you merely change the remittance address to the lessor, that doesn't mean you have to remeasure the lease. If you have kind of a blanket lease for cars at X dollars per car, and you just add the extra one, you say, I can lease 10 to 20 at these terms, and you go from the 11th to 12th. That doesn't change it. But if you have that same one for the cars, and you say, oh, I'd like to add some flatbed trucks to it, that does, in most people's judgment. So if there's any real changes of substance to the contract term, shortening it, lengthening it, changing the content, service included, service not included, anything you're taking in or out, it's important to then remeasure that lease and reevaluate it as a finance or operating lease at that moment. The capitalized indirect cost, only if they would have not been incurred otherwise. Just think of this as following fixed assets. If you buy a stamping press and you have to pour 3 feet of extra concrete in order for the thing to be able to be supported in your plant, you would capitalize that extra concrete. In fact, Dawn would even call that 7-year property. It would be capitalized, that concrete would be capitalized as part of that piece of equipment. It's the same for the lease. If it wouldn't have happened without leasing it, then you can't call it an initial direct cost of the lease and basically gross up the lease and have that asset bigger than the liability, as Jason mentioned. But if you do have those cases, you by all means do. You conform it to everything else. But one of the things you want to keep in mind is it's really good to have a capitalization policy. You should have a capitalization policy for your leases that is very similar to your capitalization policy for your other fixed assets. Because there are de minimis rules for all of these things. And what is de minimis is, of course, in the eyes of the holder, but if I have a rule that says everything under $2,500 for fixed assets is expense, and I do the same for leases, I will only evaluate for financing leases those in excess of $2,500. Oh, there we go. That helps quite a lot. And that actually carries the day. Bundled leases are to be segregated with appropriate accounting applied to each component. Once again, very similar to how you deal with fixed assets and borrowing for those. So Jason and I, in our last 4 minutes, were kind of dividing up a few things. And I was going to flip it back to Jason to talk about a few other things that we'll consider and a few things to which it does not apply.
Thank you, Jeff. So Jeff already talked a little bit about sale-leaseback guidance. And due to the ASU removing that off-balance sheet accounting for leases, sale-leaseback arrangements are going to be less attractive and will move more closely to align with the revenue recognition standards like Jeff mentioned. With regard to related parties, treatment will be the same for related parties as they are for non-related parties, and they should be classified and accounted for on a basis of the legally enforceable terms within the lease agreement. So it eliminates the current requirement under GAAP for lessees and lessors to evaluate the economic substance of the lease, and the related party lease disclosure will still be required. And then with regard to built to suit, ASC 840 provides guidance on when a lessee's involvement during the construction of an asset makes the lessee in substance the owner during the construction period. So things to consider there are if the lessee has substantially all construction period risk, if the lessee has control over the asset as it's being constructed, and you want to look at both the quantitative and the qualitative aspects during that time period to determine when that asset would be recognized and who actually in substance owns that asset. A few other matters to consider. This ASU does not apply to leases for intangible assets, biological assets, inventory, and other natural resources. Finally, you can see the effective years are beginning after December 15th of 18 for public companies, and we still have another year for private companies. Early adoption is permitted, and when the ASU is adopted, there's a modified retrospective approach to transitioning, and there's some additional guidance in ASU 2018-11, which we won't get into the details of that today, but there's some relief there on how that'll be implemented once it's adopted.
So potential changes to US GAAP. We have 1 minute and 40 seconds left. We're not going to use the whole minute and 40 seconds. We're going to just indicate several obvious things. First of all, the FASB and other like standard setters will continue to be busy. There will continue to be joint projects. Some will be very helpful. Some of the outcomes will be less helpful. The exposure drafts are out there. You can monitor them, but don't fall into the trap I did unless it's of particular interest to you of reading every exposure draft. It will not be helpful. They have exposure drafts related to debt classification, benefit plans, tax disclosures, again, helping with that OCI thing and deferred tax presentation mostly. Inventory measurement disclosures. Now this is neat because there was a little lower cost of market thing that came out a couple years ago. But I think as you look at the evolution of ERP systems, the measurement of inventory in the world of cost accounting is about to go through an evolution. And I think they recognize that our reporting and our disclosure of such things may need to evolve alongside of it. So there are different discussions on inventory measurement and disclosures. There will always be those related to fair value, derivatives, and hedging. There are several related to consolidations. Most of those have been helpful. Most of those have been helpful. Related party rental of a building is no longer a VIE that is required to be consolidated. So most of those will hopefully continue to go in the right direction, but consolidation is an important area for them to consider. And the revenue recognizing collaborative agreements, this is a new thing. The United States Postal Service, the UPS and FedEx all collaborate to take stuff back to Amazon that arrived at my house that we decided we didn't want to keep. They have to decide how to divide those revenues. They're about to get some more guidance to help with that. So stay tuned for next year. We enjoy your time this morning. And I think my partner, Melissa Bijak, is going to come forward to introduce Ms. Heather Like, the athletic director of the University of Pittsburgh. So thank you, everybody.